What if I told you that in 2005, the entire global financial system was a house of cards, and almost no one saw it coming? Not the banks, not the regulators, not the talking heads on TV. They all trusted the headlines. But one man, a former doctor with a glass eye, decided to ignore the noise. He decided to read the fine print, and what he found would make him a legend and expose the biggest lie in financial history. This is the story of how Michael Burry trusted the data, not the headlines, and made one of the greatest trades of all time. Michael Burry wasn't your typical Wall Street prodigy. Born in San Jose, California in 1971, he lost his left eye to cancer at age 2. A glass eye replaced it, and Burry would later say this loss shaped everything about how he saw the world. He felt different. He was different. He struggled to make eye contact, to read social cues, to fit in. Years later, he would realize he was on the autism spectrum. But what seemed like a disability became his greatest asset, because Michael Burry didn't see the world the way everyone else did. He saw patterns, he saw details, he saw what others missed. He was a doctor by training, a neurologist at Stanford. But his true passion was investing. Late at night, after grueling hospital shifts that sometimes lasted 16 hours, he wasn't sleeping. He was on early internet message boards, writing detailed analyses of his stock picks with a discipline and rigor that quickly got him noticed. His posts were legendary in those early online communities. He didn't just say, "Buy this stock." He showed his work, every calculation, every assumption, every risk. His philosophy was simple, borrowed from the fathers of value investing, Benjamin Graham and David Dodd. Find the true intrinsic value of a company and buy it with a margin of safety. This meant buying stocks that were trading far below what they were actually worth. It required patience. It required discipline. It required ignoring what everyone else was doing. He was so good at it that by 2000, he left medicine behind and started his own hedge fund, Scion, with a small inheritance and loans from his family. Within a year, he had returned 55% to his investors, while the S&P 500 fell 12%. The following year, he was up another 16%, while the market dropped 22%. Word spread. Money flowed in. By 2004, he was managing over $600 million, but Burry wasn't satisfied with just beating the market. He was obsessed with understanding how things actually worked. And in 2005, he turned his attention to something that everyone else was ignoring: the American housing market. In 2005, the world was in love with housing. It was the safest investment you could make. Home prices had been rising for decades. The experts said they could never fall on a national level. It had never happened before. Banks were lending freely. Home ownership was at an all-time high. The American dream was alive and well. But Burry saw something else. He wasn't looking at the news. He wasn't listening to the experts. He was looking at the source code of the financial system, the mortgage bond prospectuses. These were the legal documents that described exactly what was inside the mortgage-backed securities that Wall Street was selling to investors around the world. Each prospectus was a mind-numbing 130 pages of legal jargon, dense, boring, incomprehensible to most people, and as Burry later said, he was certain he was the only one actually reading them. What he found was terrifying. The banks had created a whole new language to hide the risk. They called subprime mortgage bonds asset-backed securities. They invented terms like mid-prime and alt-A to make bad loans sound respectable. They used complex mathematical models to turn thousands of risky mortgages into bonds that somehow earned AAA ratings, the same rating given to US Treasury bonds. It was, as one writer put it, a triumph of language over truth. Burry dug deeper. He looked at the actual loans inside these bonds, and what he found shocked him. The standards for lending had completely collapsed. He found loans given to people with no income, no job, and no assets, so-called ninja loans. He saw the rise of the interest-only, negative amortizing, adjustable rate subprime mortgage, a loan so absurd that borrowers could pay nothing and just owe more later. He found loans where borrowers had lied about their income, and no one had bothered to check. But here's what Burry understood that almost no one else did. The borrowers weren't the problem. They would always take a good deal if someone offered it to them. The problem was the lenders. They had lost all restraint. They were making loans they knew would fail, packaging them into bonds and selling them to investors who never looked at what was inside. And the whole system was built on one assumption, that housing prices would keep going up forever. Burry knew this was impossible. He saw that many of these loans had teaser rates, low introductory interest rates, that would reset to much higher rates after 2 or 3 years. When those rates reset, millions of homeowners would suddenly face payments they couldn't afford. They would default, the bonds would collapse, and the entire financial system would come crashing down. But how do you bet against the housing market? You can't short houses. You can't sell a house you don't own and buy it back later at a lower price. The housing market doesn't work that way. Burry found his answer in a little-known financial instrument, the credit default swap, or CDS. It was basically an insurance policy. You pay a premium every month, and if the thing you're insuring fails, you get a big payout. Burry went to the big banks, Goldman Sachs, Deutsche Bank, Bear Stearns, and asked them to sell him insurance on the mortgage bonds he knew were filled with toxic loans. He wanted to buy credit default swaps on the worst of the worst. The banks laughed. To them, it was free money. They were so sure the housing market would never fail, they were thrilled to take his premium payments. They thought Burry was a fool. They couldn't believe their luck. For Burry, it was the perfect asymmetric bet. His downside was limited to the premiums he paid, maybe 2% per year. His upside was astronomical, potentially 10 to 20 times his investment if the bonds failed. By 2005, Burry had placed over $1 billion in bets against the housing market. He was all in. But being right is not the same as being profitable. And this is where the story gets painful. For 2 years, Burry was right about the fundamentals, but the market was irrational. Housing prices kept rising. The bonds he was betting against kept performing. And every month he had to pay millions in premiums while he waited for the inevitable. His investors panicked. They saw the fund losing money quarter after quarter. They didn't understand the trade. They didn't trust the analysis. They demanded to withdraw their capital. They called him crazy. They called him reckless. Some of them sued him. The pressure was immense. Burry was so stressed he developed a stomach condition. He couldn't sleep. He questioned himself constantly. Was he wrong? Had he missed something? The entire world seemed to be telling him he was a fool. He was forced to gate his fund, locking his investors in against their will. It was the only way to protect the trade. If investors pulled their money out, he would have to close his positions at a loss. The bet would fail before it could pay off. This is the hardest part of trusting the data. The world will tell you you're wrong. The headlines will scream that you're a fool. Your own investors will turn on you. Your friends will doubt you. Your family will worry about you. Everyone will think you've lost your mind. But Burry had done the work. He had read the documents. He had run the numbers. He knew what was inside those bonds. He knew the math didn't lie. He held on. And then in 2007 it happened. The teaser rates reset. Millions of homeowners suddenly faced mortgage payments they couldn't afford. They defaulted. The bonds collapsed. The ratings agencies that had given these toxic securities 8AA ratings suddenly downgraded them to junk. Banks started failing. Bear Stearns collapsed. Lehman Brothers collapsed. The entire global financial system teetered on the brink of collapse. The house of cards came tumbling down, exactly as Burry had predicted. Michael Burry made a personal profit of $100 million. He made his remaining investors over $700 million. Scion Capital returned 489% over its lifetime, compared to just 3% for the S&P 500 over the same period. He had been right. Spectacularly, painfully, triumphantly right. But here's the thing about Michael Burry's story that most people miss. It's not really about predicting a crash. Lots of people had vague concerns about the housing market. Lots of people thought prices were too high, but they didn't do anything about it. Burry did the work. He read the documents that no one else was reading. He understood the mechanics of the system that no one else understood. He saw the specific, concrete evidence of fraud and recklessness that no one else saw. And he had the courage to act on it, even when the entire world told him he was wrong. The lesson of Michael Burry and The Big Short is a lesson in conviction. It's a lesson in ignoring the noise and doing the work. While everyone else was reading headlines and trusting AAA ratings, Burry was reading the data. He trusted the numbers, not the narrative. In a world of endless information, the real edge doesn't come from having more data. Everyone has access to data now. The real edge comes from having the discipline to read it, to understand it, to see what others miss because they're too lazy or too distracted or too trusting of the conventional wisdom. And most importantly, it comes from having the courage to act on what you find, no matter what the rest of the world is saying. Michael Burry saw the truth hiding in plain sight, buried in documents that no one else bothered to read. He trusted the data over the headlines, and it made him a legend. The question is, what truth is hiding in plain sight right now, waiting for someone with the discipline to find it?